So thank you very much for having me come to speak to you today. So my name is David Pitt-Watson. I'm a visiting fellow, formerly visiting professor at the Judge Business School at Cambridge University. But my background really is in investment. I'm an investor. I was the founder of the shareholder activist, the responsible investment activity at a fund manager called Hermes, and have been involved really quite deeply over the last decade or two in the whole question of environmental finance. Indeed, I chaired the UN Environment Programme's Finance Initiative in the run-up to the Paris conference. So that's my background. But what I want to talk to you about today is about something we're calling the Climate Accounting Project, which I've been leading for the past 2 or 3 years, um, with assistance from people from academia, Alan Jägerlinzer, Bob Eccles, but also from others in the investment industry and in the accounting world. Ian McIntosh, for example, who was the former deputy head at the International Accounting Standards Board and head of policy. And the Climate Accounting Project is specifically about accounting for climate. Look, we have had many initiatives, good ones and ones that I've been involved in that are about narrative reporting for companies, the front end, if you like, of the annual report. And there are very positive developments that are taking place there, I think, right now. The creation potentially of a sustainability standards board, the mandating of TCFD reporting requirements and so on and so forth. So lots of stuff that's going on there. But what we seem to have rather forgotten is what we're doing about the back end of the report, the financial reporting. And there, when it comes to the issue of climate, we have a huge anomaly. Because, of course, those accounts ought to be taking consideration of all the risks that are facing a company. So, if you've got a loan to a company who might go bankrupt, you've taken that into account and written down the loan if that's the appropriate thing to do. But if you think about the challenge of climate, it's simply not included. And I think this has happened because all of us in the accounting world have allowed the frog to be boiled. What do I mean by that? Well, look, if you go back to 1980 and someone had said, look, when you drop the accounts of any company, we expect to see explicit issues related to climate, they would have said, well, that's just not relevant for almost every company. And maybe it wasn't relevant in 1990. And then 1991 and 1992 and 2000 and 2010 and 2020 and 2021, climate is a massive issue for many companies, oil companies, coal companies, for example, but also diesel engine companies, airlines, you name it. It's a huge issue. But we've boiled the frog. And therefore, we're reaching a 99 degrees centigrade, and we haven't yet pushed this into something that needs to be considered where it's material in drawing up accounts. And that is a big gap. It's a big gap because accounts really matter. They really matter. Actually, they matter, I think, more in terms of behaviors than the front end reporting, however important the front end reporting is. And they have always been at the core of what it is that investors use in order to hold companies to account. And they really matter because it's through the accounts that you determine what the profitability is. It's through the accounts that you determine what the solvency is. And therefore, the accounting information isn't just exogenous, like taking the temperature of the patient so that investors can then do something about it, as other reporting might be. This is endogenous. If you change the way in which the profit is calculated, then you change the behavior of the company. Look, I'm sure you can find 101 examples of this, but I mean, just for the avoidance of doubt, let me give you an example. So imagine you've got somebody who's built a coal-fired power station. They spent $1 billion on the coal-fired power station, and it's going to have a cash flow each year, a net cash flow of $50 million a year, so a 5% cash flow. Now, the technical life of that coal-fired power station is 50 years. And if you depreciate it over 50 years, you will have a net profit of $30 million every year. But we know that coal-fired power stations need to be closed down and closed down fast. If you were to depreciate that coal-fired power station over 10 years, that would be a charge of $100 million for depreciation. It's only making a $50 million cash flow. It's now loss-making to $50 million, and therefore you will not build that coal-fired power station. So the accounting really matters in terms of what people do, and historically we've had this enormous anomaly that we've not been taking it into account. I say historically because this is beginning to change, and I think these changes are hugely important for the way that accounting is practiced, the way it's taught, and the way it's researched. The change comes, I think, first from an opinion from the International Accounting Standards Board. Now, I was one of the leaders amongst the investors in approaching the IASB and saying, look, we have this huge anomaly. We don't think you need to write a new standard about climate. You simply need to say that when you depreciate that coal-fired power station, you need to have taken climate risks into account. When you value that oil well, you need to have thought whether it's reasonable, as most oil companies were doing a couple of years ago, to suggest that oil is coming out of the ground in 2050 and it's receiving $80 or $100 a barrel, and so on and so on. And that indeed is exactly what the IASB did. They followed that up with education material and umpteen different speeches, which says, look, if you are using IFRS, which is of course set by the International Accounting Standards Board, if you're using International Financial Reporting Standards, you must take climate into account where that is material. It's material where the investors think it's material, yeah, and you need to show what assumptions you have used, material assumptions you've used in drawing up those accounts. And clearly investors are supercharged about climate. So if in doubt, you want to be declaring your assumptions rather than not declaring your assumptions. So that's the International Accounting Standards Board. And we then followed that up with an approach to the International Audit and Assurance Standards Board, who essentially said the same thing as regards the audit. Yeah. So if you're the auditor of someone who is using IFRS, you need to make sure that they have taken climate into account and that the assumptions are properly shown. So that's one big step forward. But there's a third, and I think it's the third that really gets us to where it is that the world needs to get itself to, which is an open declaration, a public letter from the very biggest investor groups from around the world. So that includes the $1 trillion Principles for Responsible Investment, the however many tens of $1 trillion Institutional Investor Group on Climate Change, the Asian Institutional Investor Group on Climate Change, and the Australian Group on Climate Change, the International Corporate Governance Network, and others. And what they've said is, we want to see these standards applied by companies and by auditors. We want to see the assumptions, and by the ways, we also want those assumptions to be consistent with sustainability. So look, if you draw up accounts so that they are consistent with sustainability, we are starting to, in fact, we are moving a very long way in creating companies whose profitability is a sustainable profit. And by that, I don't mean, and of course, as accountants, that shouldn't be difficult for us. I mean, that's what accrual accounting was all about, wasn't it? That we were making sure that this wasn't a Ponzi scheme that had cash for now, but not for later. It was that the profitability that was declared was a sustainable profit. And this is essentially saying, look, that's what we need to see in the accounts that are coming forward from companies today. That is quite, I think, quite a big change. But we're in the process of this change. This is, I think, not a done and dusted change. So let me talk about what I think some of the issues are for us as the climate accounting project. And then I'd like to talk just for 2 or 3 minutes about what this might mean if you're somebody who teaches or researches accounting and is interested in this topic. So first of all, let's talk about what this means for the climate accounting project. Well, the first thing is we have, I think, very clear judgments from the IASB and the IAASB. We do have judgments that push in the same direction from the FASB as well. So that's the American Accounting Standards Board. And we could do with that being a little bit tighter. And we could also do with a similar a sort of opinion from the PCAOB in the United States. But to be honest, the standards by which accounts are drawn up in the States and in the rest of the world, the principles of them ought to be identical. And if the interpretation that we got from the IASB is correct for IFRS, then surely that interpretation would also be appropriate for US GAAP. And similarly from the interpretation from the IAASB and the PCAOB. It cannot be surely that we're saying that accounting is simply a matter of following the rules, and if climate is not mentioned as a risk, we therefore don't need to take it into account. That would be absolutely crazy if we thought that that was the way that things are doing. So this should already be applying in the United States, but some clarity would be helpful. We're then working with investors particularly to say, look, we need to have this as the core of what it is that you're saying you want from the accounting profession. The accounts, of course, are drawn up for the investors. And you'll see that in the letter that's drawn up by the public letter that I mentioned, drawn up by the big investor groups, but also you'll see it from BlackRock. Financial reporting should reflect reasonable assumptions about the impact of climate risk and the transition to a low carbon economy. That's one where global warming is limited to well below 2 degrees C. So you've got big investors saying, this is what we want built into the reporting. So there's some work that's going on with them. There's some work that's going on with the regulators as well. I mean, it's quite interesting in the UK, the FRC, the Financial Reporting Council, has reviewed accounts and has been very clear in saying these are not meeting the standards as regards climate. Well, look, if they're not meeting them in the UK, I can assure you that UK accounts are no worse than the accounts that you would find in other parts of Europe or around the world where IFRS applies, and certainly no worse than the ones that are being published in the United States. So it does seem to me that there's a lot of work for the regulators to do, and indeed for investigators to do, about how this can possibly be included in what it is that's taking place. And we're also in discussions with the auditors. They have written a letter publicly to say that they will respect the IASB, IAASB opinion. But frankly, the work that's coming in so far, they've got a long way to go before that is done properly. We have now reviewed about 100 companies around the globe, looking at if you apply those two opinions and the letter from the investors, how far those 100 accounts would stand up to that scrutiny. And the answer is they fall rather short. So that's the work we'll be doing. But what about academics? I mean, I think this is just such an exciting area. And as I say, we've already been helped a lot by Alan Yigelinzer, Bob Eccles, Ellen Quigley as well from Cambridge, who's been important on this. I mean, it seems to me this should affect what it is that we're teaching. So when we are thinking about how you draw up a set of accounts, it must be clear that a climate needs to be taken into account if you're valuing a if you're depreciating a coal-fired power station and thinking about its life, if you're valuing an oil well, and in all sorts of other places as well. Wouldn't it be good to have that in the curriculum so that as people are graduating and becoming accountants, this is something which is not coming currently from the accountants that we've got, that it is natural that this needs to be taken into account, that the water is very hot and the frog needs to jump. I think that would be enormously helpful if we were all teaching that. I also think that there are areas for research. I mean, one would be just be the history of how is it that we've managed to overlook this for so long? What happened in the institutions that went wrong? But also, what is it that's happening now? Here is a very clear change that is being made by accounting standard setters. What is being the effect on the ground? How can we understand what that effect is? And how can we learn from that for the next time so that we know how we do this better next time? And then finally, I mean, we are spending some considerable time going through the accounts of the 100 of the most exposed a, a, companies, climate exposed companies in the world, to see how far they're adopting this. If this data that we're creating can be of any use to somebody who is researching this, then we would certainly want to help with this. So look, I hope that's been interesting. There are some big changes and some urgent changes that are needed, I think, in the way that that accounting is being done. We're on the case, but we're a small group of people representing investors on the case. We need everyone to be behind this. And boy, are there interesting things for academics to think about when they teach the core accounting classes, not just the ESG reporting classes. Really interesting things for them to teach, and some very important stuff that is going on that I hope some would turn their attention to in their research. But look, let me stop there, and thank you very much for inviting me to your conference.